Breaking news. Singapore's economy grew 3.9% in Q1, but MTI warns of tougher times ahead. Let's dive into what this means for you. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. Singapore's Q1 GDP grew 3.9% year-on-year, slightly better than early estimates, but MTI has kept its full-year growth forecast at just 0 to 2%. Why? Because the economy actually shrank 6% compared to the previous quarter. This quarterly contraction is significant. MTI's permanent secretary admitted today that a technical recession is now a possibility for Singapore. 2 consecutive quarters of contraction would mark our first recession since 2020. The main culprit? US-China trade tensions. There's been some relief with a 90-day tariff truce, but MTI still sees major risks ahead. Looking at key sectors, manufacturing grew 4% year-on-year, but shrank 5.8% quarter-on-quarter. Much of Q1's growth came from businesses rushing shipments before expected tariff hikes, a temporary boost that won't last. Construction grew 5.5%, while services sectors showed mixed results, with retail barely growing at 0.1%. How does this affect you? Expect a weaker job market as companies become more cautious about hiring. If you're in trade-related sectors like manufacturing or finance, prepare for slower growth. For property investors, real estate grew 7.1% in Q1, but demand may soften with rising economic uncertainty. The good news for CPF members, your special and retirement account interest rates remain stable at minimum 4%, but slower economic growth could eventually impact wage increases. MTI highlighted 3 key risks: businesses and households pulling back on spending due to uncertainty, trade tensions flaring up again after the 90-day truce, and potential financial market instability. There are bright spots, though. Singapore's position in global semiconductor supply chains gives us an advantage as AI technology demand grows, and our transportation engineering sector remains strong. My quick recommendations. First, diversify your investments away from sectors exposed to US-China trade tensions. Second, boost your emergency savings. Third, watch the trade negotiations closely. Their outcome will significantly impact Singapore's economy. Singapore has weathered economic challenges before. While we should prepare for tougher conditions ahead, remember that technical recessions don't always mean severe economic pain. The government also has resources to stimulate the economy if needed.